Macro analysis is as important as it's ever been, given key questions about the Fed, the economy, and big picture themes like the AI boom. That's the message I heard from one of my Money Show MoneyMasters podcast guests this week. From the other, that bottoms up research, the identification of corporate inflection points, and the ability to let your winners run when you get the investing story right is most essential. And that's why I'm so excited about this week's episode. You're going to get two different worldviews from two different experts who specialize in two different approaches to the market. And they're both all new guests on the podcast. One is Nicholas Bohnsack, President and CEO at Strategas Securities, and the other is Amy Zhang, Executive Vice President and Portfolio Manager at Alger. Thank you both for joining me. Amy, Nicholas, or I guess NB is what you said to use for you. It's great that I could have you on the show here. I appreciate you both taking some time out for the podcast. Since you're both first-time guests, I would appreciate if you maybe just introduce yourself a little bit, talk about your background in the business and what it is that you do at each of your firms. Nicholas, I guess we'll start with you at Strategas, and then we'll roll over to Amy.
Oh, you're very nice. Well, it's certainly nice to be here and with you both. So I'm Nicholas Bohnsack. I'm the president of Strategas Securities and Strategas Asset Management. We are a macro research and asset management house, focused on all the major macro verticals, and ultimately our clients. We endeavor to be the one-stop shop for macro. So our clients are institutional investors, wealth advisors, and individuals alike.
Wonderful. And Amy, same to you from Alger.
Yeah, I'm the executive vice president and portfolio manager for our small and mid cap products at Alger. I run 4 products: small cap focus, small cap growth, mid cap focus, and an ETF FRTY, which just surpassed 100 million. I consider Alger a growth pioneer, and we've been in business for over 60 years.
Wonderful. Well, there's a lot to unpack. We'll probably start a little bit at macro and then go from there. So Nicholas, I'm going to go to you first. In this environment, obviously, we're sort of hovering around highs. We've had an incredible rally back from all the tariff and trade-induced sell-off experience we had in February, March, and April. What is your take on where markets stand? I mean, how would you characterize this environment?
Yeah, it's funny. We go through a pretty, I think, exhaustive, only because we do it all the time, exercise trying to poke holes in whatever the conventional thesis is. And truth be told, it's very difficult to find a lot to be overly concerned about, with respect to risk assets. And so when you consider sort of that as a starting point, it's tough to fade the bull market in equities right now. It's perhaps tough to fade even some of the bull market that exists in some tranches of credit. But at the same time, valuations are getting to fairly lofty levels. Corporate credit spreads are on 25, 27, 28-year tights. We clearly have, a lot of uncertainty as it relates to policy and the implementation of policy, even if we have some clarification on taxes and tariffs. So the way I look at it increasingly is that the market is pretty priced to perfection. It may go a little bit further, but we want to start to train our attentions towards what could go wrong, and there may be a little bit of chop and volatility here as we move towards the year end.
Got it. Amy, what about your thoughts on sort of the big picture before we kind of dive into the small and mid cap space? I mean, do you tend to align with what MB was saying there, or are you a little more constructive, less so?
Well, I'm very constructive on small and mid-cap growth companies, because I agree with Nick that, in terms of market is being very, very narrow, right? So the big mega cap make the Magnificent Seven, and the mega cap, and has been done so well, and so valuation, I think, is very high. And the valuation gap between large cap and small mid-cap growth companies, I think, is so wide that a truck can drive through it, right? So historically, usually would trade as a premium given the law of small numbers for small mid-cap growth companies. And we still have a lot of high quality small mid-cap companies. So to that extent, I think now I'm very excited. I think finally, we're done with the rate hikes, right? Part of the reason why especially small cap growth has been the worst performing asset class for the last 3 years. I've been in business for 30 years, and I think that was the worst 3 years. So finally, I think the headwinds of rate hikes are going to turn into tailwinds of rate cuts. So that itself is going to be a very positive factor in a small mid cap growth. But of course, it's also fundamentals, which we focus a lot on. I'm very excited because I think finally with headwinds turning into tailwinds, that we will finally get back to stock pickers market for small and mid cap growth. The market is going to continue to broaden.
I'm glad you brought that up because we had that day or those couple of days after I think the CPI numbers where the Russell had a pretty big move to the upside, and that was one of the things some of the strategists have said, oh, we've been lagging, but if we see that part of the market kick in, and it seems to that you seem to think this is probably sustainable, yes?
Yes, because I think, labor market probably will continue to be weak because AI is very deflationary, right? Like, so to that extent, that's a transformative force that I think and the economy, hopefully we can muddle through, but we are worried about maybe, the growth. So growth is going to become scarce. So what we do is identify exceptional small mid-cap companies that have the wherewithal to become exceptional large companies. So when growth becomes scarce, the kind of company can truly grow through idiosyncratic drivers will really shine. So I think the winner is gonna, shine through, and that's our job at Alger, to be stock pickers.
Got it. Nicholas, let me pivot back to you and talk about the big picture. I mean, we've got, we're sort of parsing Powell this week, depending what he has to say. We're all wondering CPI versus PPI, what's right, what's leading, and all that. What are your thoughts on that being a market driver one way or the other? I mean, do you think we're overly concerned about the Fed here, under concerned?
Well, we certainly spend a lot of time, wringing our hands over what they'll do next. And I'd say, political pressure notwithstanding, the Fed is trying to really articulate the last 20 yards of a pretty difficult trick, right? You've got inflation, as you mentioned, in some of the PCE and other producer price data that remains pretty sticky. And I think there's a fair argument to be made that some of the tariff-related price adjustments, albeit one time, could lend themselves to sort of re-elevating inflation as a principal point of concern. So the Fed has sort of a tricky dance to play. I also think, though, that the case is building for monetary policy to be more neutral as opposed to restrictive. And that may be what the president is getting at. Of course, the proclivity of most presidents would be for easier monetary policy outside sort of the exogenous circumstances. But I don't know that we're spending too much time on it. At the end of the day, monetary policy probably has to move back into neutral territory. How quickly they do that is what will provide some dislocation. If you think of the consensus believing that a 25 basis point cut is going to come in September, or even as the Treasury Secretary interestingly suggested, a 50 basis point cut, you look at the 2-year, they want 75 basis points of cuts. So there's a fairly wide gap between where the market is, where the prognosticators are, and maybe even where the administration is. What I look at as we move towards the end of the year is, can the sort of organic drivers of growth, we talk about artificial intelligence, we talk about the industrial power renaissance, we talk about some of the other CapEx incentivized investments that might be made up on the back of the tax bill and the spending bill. Can those kick in before we need accommodative policy to prop the economy up? Our eyes will really be focused on labor. And I think, the Fed comes back into the picture when you start talking about labor. So I'm not sure that we're spending too much time. It's really a function of how long it's going to take for the Fed to get where it needs to be.
Got it. Well, let's talk about the earnings outlook here. I mean, we're pretty much through the second quarter earnings season. I think I saw the number, we're up about 11%, and heading into season, we're only expectations were about 4% growth. Yeah. What are you seeing in the big picture, Nicholas? And I guess, Amy, then I would ask you in the small and mid cap space, what kind of growth you're seeing?
Well, I'll start with the earnings picture in general. I think I saw two major takeaways from the second quarter. Number one is, of course, we had the post-Liberation Day downward revision, lowering of expectations. You note here in the question that we've exceeded those. Importantly, we've exceeded the levels that existed prior to Liberation Day. So all in, a very, very strong quarter in the aggregate. I think the takeaway, though, is that the mix is changing. So whereas you see strength in tech, strength in financials, you're seeing some weakness in industrials, some weakness in healthcare. So the deck chairs are being rearranged for the second half of the year. And that's why I think those special drivers are going to be really, really important. The other point that I would make, which has really been key to our I guess, embrace of the bullish thesis generally is, can companies continue to build the revenue stack? If you can get top line growth, irrespective of how you might manage to the bottom line, this economy is in really good shape. If that starts to falter, then we may have a little bit of trouble ahead, particularly if inflation remains stickier towards the back end of this year and early next year.
And Amy, again, in your space, when you're listening to these conference calls and you're hearing what some of the companies had to say, what's the general story out of the small and mid cap space for the earnings season here?
Well, we had a very strong overall, very strong earnings season, and I just want to point out, I think Nicholas is when Nick's gonna talk about revenue. I think it's very important for us. It's our my playbook is really about identifying companies early, right, and a lot of small numbers. So we define smallness in terms of revenue especially for small cap. So to that extent, it's all about, for us, it's really all about robust and sustainable, durable revenue growth. So with that, because operating leverage goes both ways, right? So once you have that, and then of course, we focus on company with strong unit economics, then you will trickle down to the bottom line. So it's really about companies who can grow, have robust top line growth, and also have margin expansion, and profitability will fuel EPS growth, and EPS will drive stock price. I think that will, because for us, valuation is already so low, right? So those are being compressed, so the companies can truly grow top line and bottom line will continue to shine, and those are the kind of companies we focus on.
Okay. Any particular sectors within your space, or if you're comfortable naming a couple of names, stocks that you think really have a good story to tell here?
Yeah, we are, at Alger, we're bottom up investors, but of course, but we're not like looking at companies a vacuum. We really care about the key themes, and we're benchmark agnostic as well. But as a whole, clearly we've been, for example, overweight industrials. Clearly with the AI, the common sort of theme which we are in, data center and infrastructure and so forth. But we also invest in compounders, right, in industrial, which I can maybe name one, like RBC bearings, right? There's a company that does highly engineered and precision bearings. They have on mission critical products like airplanes, submarines, missile defense systems. So they have three segments. Aerospace and defense is being faster growing but very strong. Industrial, they have not, that their industrial space is very sort of diversified, not cyclical, and actually the big and beautiful bill will benefit them. So to that extent, the company has been generating massive cash flows with strong top line growth, and we this is a company we invested in November 2020, and we still believe that they can continue to be high quality compounder. So that's actually a industrial name that maybe not necessarily a household name. And then, but we really invest in every sector. It's really about finding the hidden gem, right? In small mid cap, it's all about the discovery value. So I know small cap, not only small cap growth has been the worst asset class, but small cap health has been the worst sector. But even with that, I think, I always believe we always invest in company that we want to save time, life, money, headaches. I think healthcare is still very important. So one of the companies that we invest in about a year ago, September last year, is called GeneDx. GeneDx is a genetic testing company that focus on exome and genome testing for rare disease. So they started with children, right, pediatrician, and pediatrics, and then going forward, we think they can expand. They're already expanding to babies, and going forward be adults. But 1 out of the 10 Americans have rare disease. Half of them are children. So clearly, what they do is very important. And specifically, recently, this year, June, just a few months ago, the American Academy of Pediatrics issued updated guidelines that elevated their testing to be first-tier test for children, with global development delay, or intellectual disability. So that was a huge validation, even though they're not going to start generating revenue from that specific catalyst until next year. But so far, the company has generated tremendous revenue and profitability growth. We always look for the inflection point. So when we invest in it, the quarter we invest in September, that quarter they become profitable, right? So for us, and then they are very small. Their revenue last 12 months revenue is only about 360 million, and their market future TAM could be over 40 billion. So clearly a lot of small numbers, and they're really hitting on all cylinders. So I think still, even again, like in every sector there's very interesting place. And then last but not least, they are also very underappreciated AI play, because they have a very strong moat. In genetics testing, data is super important, and especially the interpretation of data is the heart of the whole business, that they can do it faster, cheaper, with more accuracy than their competitors, which gives them a very wide moat. And so this is really a very much underappreciated, AI play. But last but not least, we also have a long-term holding in Wingstop, right? That's a consumer name that you're probably familiar with, highly, very high quality company that, I think they're really in the category of one, in terms of unit growth and comp, but also, highest industry leading cash on cash return, 70%. But more importantly, I would say, Wingstop is really a technology company that sells chicken wings. Most recently, they roll out Smart Kitchen, right, with the AI engine to predict demands, and they use AI in other areas. So that can cut into, like, say, wait time in half just with the Smart Kitchen. So anyway, and we really focus on scalable, profitable growth companies.
All right. Well, my daughter's a fan of Wingstop, so when she watches this, she'll be happy to hear that recommendation. Nicholas, I guess same question to you, whether, I don't know if you can talk individual names or just sectors, things that you think look potentially more attractive heading into the rest of the back half of this year, just given sort of your macro view.
Yeah, I mean, for us, macro really comes down to themes. And as you know, we manage a small suite of 3 exchange traded funds. And the one that I'm responsible to principally is the Strategas Macro Thematic Opportunities Funds, $200 million now SAMT. And what's, I think, important about it is that it's thematic rotation. And so it's not beholden to any one theme at any one time. We can, as the business cycle evolves and the macro environment evolves, we can rotate among the themes. And so we have 4 principally right now that we're invested in. We mentioned artificial intelligence earlier. I do think there's a shift afoot from compute capacity building and large language model development to a more agentic, contextual, inference sort of application of AI. That business use case is very, very appealing for some differentiation in the portfolio. We mentioned the industrial power renaissance, sort of this insatiable need for power, not just by Americans, but globally. I mean, the number 2 use of power in this country is keeping things cold that want to be cold and keeping things hot that want to be hot, and that's not likely to abate. So the industrial power renaissance is very much in the fore of our focus as we move through the balance of this year and into next. And then the 2 very quickly that we didn't mention earlier, number 1 is deglobalization. Fortunately or not, I think it's going to define a lot of the investment decision making that we undertake over the next decade as a group. You saw it on full display yesterday at the White House in Alaska, earlier this week. So deglobalization is principal, and it cuts through a lot of different threads. If it's intellectual property sharing, defense and rearmament, natural resource utilization, supply chains, et cetera, that's certainly of importance. And then the last one, which I think is a little bit of I'm careful to use the word hedge, but we want to be mindful that things have gotten very rich, is cash flow aristocrats. These are companies that can self-fund in periods of uncertainty, whether that be uncertainty specific to their business or more broadly in the economy. So from our vantage point, those are the 4 themes to watch as we move through the balance of this year and into early next.
I guess sticking with you, Nicholas, I'm just wondering, are there any issues that you think maybe people aren't appreciating enough as a risk factor in this market? I mean, again, we've had such a head of steam, and I'm just curious. I don't try and be a Debbie Downer or anything like that, but I'm kind of curious as we head into the back half here if there's something that you think people need to be kind of paying extra attention to.
Well, listen, I'll be honest with you. I mean, when things are really bad, my job and our firm's job is to look for things that are great. And when things are really great, our job is to find the things that may be more worrisome. And so things are pretty good right now. I think the biggest concern I have, as you think about the underpinnings of the economy, is what's happening in the labor market. There is a school of thought that says, hey, listen, some of the policies that have been undertaken by the administration or some of the efficiencies that have been perhaps gained by technology are, causing some dislocation at the lower income cohorts, and that's absolutely true and valid. But on a propensity to spend basis, that's a far smaller group than what we see existing at the higher income and wealth cohorts. So labor generally and consumption looks pretty strong. But if you start to think about some of the tightness in credit, if you start to think about some of the pressures that could be intended on household credit in particular, that could start to weigh on the consumer. And so if I had to say, what's one thing that really worries you, and we're always a tweet away from Armageddon, it seems, it would be on the consumer side in sort of a classical economic sense as we move through the balance of the year. And inflation doesn't help that. Either because it's a regressive tax, obviously. We've managed to keep it at bay because of lower energy prices. But if that should reverse for any particular reason, the consumer comes under more pressure.
Got it. Amy, and both of you obviously are going to be joining us for the 25 Money Show Traders Expo in Orlando this October. Since you're a new first-time speaker, Amy, any thoughts on, somebody comes to your presentation there, what it is they're going to pick up, what it is they're going to learn? I know it's still a little ways out though.
Well, I hope I'll have opportunity to talk about the new cycle for small mid-cap companies, that because I think the current policy will favor that. It may take time, with lower rates, lower taxes, stimulus, and a big beautiful bill, but also deregulation, which will foster more M&A, and the small company specifically will benefit from that, and also just maybe sort of the kind of playbook we have in exceptional growth companies, because as you know, it's rare to find those exceptional growth companies. So our job is to find them early and be directionally correct and let winners run. So it's really about slugging. And I hope I will have opportunity to talk about those exciting opportunities.
Wonderful. And Nicholas, I know, again, we always say we get these topic titles pretty far in advance. Yours is
Yep.
Navigating Cross Currents, Policy, Markets, and Themes in the Age of Trump. Anything that we haven't covered that, again, somebody's going to be coming to this to see you speak, what they're going to take away from that?
The only thing that I know for sure is that the importance of macro on portfolio construction and trading is not going to abate in the next 6 weeks. So we are living in, depending on your perspective, the golden age of macro, and particularly its importance for investors to consider. So, we're going to bring our latest thinking on it. The title encapsulates sort of the broader lens, and we've talked a lot about sort of the pertinent issues today. Those won't abate. We'll probably add a few more onto the stack, but macro is as important as it's ever been, if not more so. And I look forward to chatting about it with all of our guests.
Wonderful. Well, Nicholas, Amy, thank you both so much for your time, your insights here. Viewers, if you're watching this, you are going to learn more strategies, actionable ideas from both of these experts. If you join us for that event, it's the Money Show conference in Orlando, October 16th to 18th. You can find complete event details and a link where you can register to attend in the description below. Nicholas, Amy, thank you again so much for your time.
Thank you.
Thank you.